Hey guys, Robert here with the Cash Compound. I wanted to make sure that we do a series of things that we don't normally talk about when we talk about infinite banking and the concept of becoming your own bank. So a lot of people, they know a lot about, taking back control of their money and having the ability to not finance through a bank or third-party organization. What we don't talk about is the advantages that comes with being your own bank outside of the obvious, right? So I'm going to have a series here where we're talking about nothing but that. So please, I invite you to come on this journey with me as we go through a series. I don't know exactly how many parts it'll have to it, but you're definitely in for some good stuff. We're going to talk about the things that you simply do not think about when it comes to infinite banking and becoming your own bank. So let's get started. Number one thing I want to talk about is I noticed we don't talk enough about debt to income ratio, and we will have some visuals, but just walk with me here as we go through a small explanation of exactly what I'm talking about and how it impacts you when we're talking about becoming your own bank. If you have private debt, it doesn't show up on a public ledger. This public ledger that I'm referring to, you might know it as Equifax, Experian, and TransUnion. What am I talking about? I'm talking about your credit score, right? I'm talking about your credit score that they judge you on when you go to take a loan from the bank or finance a purchase. If you don't have that additional debt, and that debt is with yourself, it's a private debt through a private banking system that you own and control. When you go to leverage the banking system at any point in time in the future, you're going to be able to leverage the system even more because you don't have that debt showing up. It's important to understand that while we want to be our own bank, and ultimately that is the goal, let's be very realistic. Most of us are going to start at a place where we cannot afford to finance the vehicle right out, right? We might not be able, if I want an $80,000 car, I don't want to spend cash. We know why we don't want to spend cash, because if we spend our cash, we lose the opportunity to earn interest on that cash. That $80,000, I could be earning interest on my dollars while simultaneously financing that vehicle and enjoying it right now, rather than taking the $80,000, putting it down on the vehicle and starting back at whatever number I had prior to spending that $80,000. For an example, if I have $180,000 in my bank account, I take $80,000 to purchase that vehicle, I go down to $100,000. Let's say this bank account is earning me interest. If the bank account is earning me interest, let's say for simple math, 5%, 5% of $100,000 is what? $5,000. But if I have $180,000 inside of that account, how much more am I earning? About $4,000 more dollars. So the opportunity cost of me taking the dollars out of that account and putting it towards this vehicle is missing out on the opportunity to earn that interest. So what's the next obvious step? Financing, right? So we want to finance this vehicle. And when we finance this vehicle, if we do it through ourselves, we know the benefits that comes with that. We keep the interest payments and we become wealthier while still being able to enjoy this vehicle. But what happens when you need another vehicle? What if you need another car, right? You get married, the household changes, more responsibilities, larger family. What happens if you need another vehicle? If you paid off that first vehicle using your policy and that debt is private, what shows up on your credit score is a fully paid for vehicle. So if you go to the bank and you want to leverage to get another vehicle, you can do so. Right? And it's not showing up that you purchased the original vehicle through your policy. But bringing it back around, what if to begin with, we cannot afford at the moment to take the $80,000 out of our policy? By us having more debt that is private, whether it's to refinance our credit cards, whether it's, paying down student loans, whatever the case is, any debt that we have that's private is not showing up on a public ledger, on a public credit statement. It's not showing up on our credit report. So if I go get this $80,000 car, and obviously, I just started my banking journey. I don't have that much cash inside of my policy at the time. My cash value hasn't occurred to reach the $80,000 mark that I need to buy this vehicle. Because I don't have debt that shows up on my credit report, my debt to income ratio looks very, very good when I go to the bank to try to make the purchase for the $80,000 vehicle. So to bring it into close, and I hope I didn't lose anybody. If I did, make sure you rewatch this video, and we'll have more series coming, part 1, part 2, part 3, and as many as we need to get down the little things that we miss when we're talking about becoming our own bank and the advantages that comes with it that we just don't think about right up front, right? So make sure you rewatch the video to understand a greater concept of what I'm saying and really grasp that, because it's really, really important for you to understand it. And more importantly is watch the new videos. Make sure you subscribe to the channel, leave a like, comment, let us know what you're thinking, because I'm going to come back and I'm going to talk to you to help you understand exactly how this can impact you and benefit you into the future, except it's going to be with visual representations as well. So this is your introduction to the little things you did not know about becoming your own bank and starting Infinite Banking.